Yeah, Tyler, I think it's probably too early to tell whether it's a longer-term trend or just quick trade. We've seen money moving so fast among sectors these days that it's hard to draw any long-term conclusions. But we've noticed a lot of the things that Bob represented as well, and financials would definitely be one of them. And, yeah, we do like that sector. We think it's been undervalued for a while. It obviously hasn't kept up with the broader market. Valuations are attractive. Business conditions are pretty good, and consumers are spending and borrowing. And so wealth management, business transactions, M&A. I mean, a lot of these companies are hitting on multiple fronts from an operations standpoint.
What's the
so we like them long
for you?
term.
What's the sweet spot in that banking sector? Big banks, regional, smaller banks, what?
We have exposure to a lot of those sectors. Asset management, regionals, and the big banks, we like them all. I think probably the biggest potential operating leverage might be in the regionals because there's the best chance for, middle America borrowing, spending, growing, whereas I think the bigger banks have been a lot more well-defined, I guess you could say.
So, Tim, are we a little jumping the gun in calling this a rotation, or is it really just that?
Well, look, over the last year and a half, people have complained that risk-reward, there's been a fair amount of volatility, and the stock market's done almost nothing. But you have seen these major periods of rotation. And if I look at banks and then taking it back even further, what's driving banks here clearly is we got so overbought in terms of bonds. So yields which were as low and on a relative basis were as overbought, so yields lower than they had been since the financial crisis. Typically, when we see that type of a rebalance, which is what we talked about at the end of the month, what we were going to certainly see out of pension funds was it tends to be equity positive. What you had in 2016 when we were coming out of this concept of were we going into a recession is you had an enormous rally point for the banks. But we've had a 20-something basis point move in the 10-year, and that's equated absolutely to the money center banks. And as discussed, the regional banks probably have the most leverage to a yield curve that it's not so much that it's steepened, is that yields are actually moving higher, and this augurs more optimism.
I get the move in the banks completely, Tim, but when you take a look at the moves, for instance, in the Russell as well as retail stocks, I mean, that's sending a signal, right, that the economy is getting better. I mean, what has changed to make these sectors go higher? And is the bounce that we've seen in these particular sectors more akin to a dead cat bounce?
Well, first of all, retail, which had underperformed the S&P over a year by about 20%, is now outperformed by about 6% over the last 4 days. It's been an extraordinary move. I think a lot of the deflation trade that was out there, you were talking about gold earlier, we've talked about yields, we've talked about some of the defensiveness, even the food stocks, which have rallied to multiples that really don't make a lot of sense. Banks multiples make a lot of sense here. And if you look at the transports, look at the breakout in FedEx. This is a company that's been trading at basically a trough earnings multiple. And I think investors at this point have some more confidence that the economy is not falling on its face. The central banks still hold all the keys, but rotation has been part of this market for the last couple of years.
Do you believe that the economy is not falling? I mean, have things in recent weeks, Tim, improved to the point where you're saying, you know what, the economy isn't as bad as everybody thought? And
let me explain that. Because on the manufacturing side, no. You looked at the ISM and you look at the PMIs, you look at the market PMIs, but you looked at the ISM services, and that was better than expected. That was printing almost a 57. You have consumer confidence numbers. You have consumer spending. Whether you think it's good or bad, and it's good for the banks, you've seen consumer credit numbers come out, and revolving credit and non-revolving are effectively at record highs. So the consumer right now, and certainly those that tend to be spending in some of those parts of the lower income stores and whatnot, have jobs and are actually making more than they were. Right now, no. The consumer's not falling apart, and I think we've had some reaffirmation that despite the fact that yields were going lower, a lot of this was driven by bunds. A lot of this is driven by ECB policy. I believe the relative value trade had a lot of the U.S. dynamics being pulled down on a yield sense.